Most Forex accounts don't die from bad strategy. They die from 8 risk mistakes. Here's the fix.
Most retail Forex traders don't blow up their accounts because their strategy was bad. They blow up because their risk management was wrong. Here's the part that hurts. You can have a winning system on paper, positive expectancy, clean entries, the works, and still hand it back to the market inside 6 months. Why? The position was too big. The pairs were correlated. The stop was 15 pips on a chart where normal noise is 20. 8 rules separate the trader who survives from the one who reloads. Let's walk them, and the 1% rule everyone has heard is going to look very different by the time we're done. Start with the stop loss, because if you don't have one, you're not trading, you're gambling. And the way most people place stops is wrong in a specific way. They pick a number, 20 pips, always 20. That's not a stop, that's a habit. A real stop lives at a technical level, beyond support, beyond resistance, somewhere price has to break structure to reach. Why does that matter? Because the market doesn't care about your 20 pips. Euro US dollar on a 5-minute chart routinely chops 15 to 20 pips inside normal noise. Set your stop there and you'll get knocked out before the move even starts. Then the move runs without you. But there's a second trap. Place the stop too far, say 100 pips, and your target needs to be at least 200 to justify it. If the real target is only 120, your reward to risk is 1 to 1.2, not worth taking. One last detail nobody adjusts for. Your stop fills at the bid if you're long, the ask if you're short. Add 1 pip for spread reality. Small detail, real money over a year. Now the part that flips most retail traders upside down. Win rate. Most people chase it. 70%, 80% winners. It feels good, it looks good, and the account goes nowhere. Here's why. A 70% win rate paired with a 1-to-1 reward to risk gives you almost nothing in expectancy. The math doesn't reward feeling right. It rewards being right by enough. Look at the numbers. A 30% win rate with 1 to 3 reward, that's a positive expectancy of plus 0.2 R per trade. 40% at 1 to 2, same thing. 50% at 1 to 1.5, plus 0.25 R. The best executed retail systems cluster at 40 to 50% win rates with 1 to 2 or 1 to 3 reward to risk, not the high accuracy systems, the asymmetric ones. The reason is emotional, not mathematical. High win rate systems mean rare large losses that wipe out long strings of small wins, and those losses arrive right when you've started to trust the system. The asymmetric system inverts that. Lots of small losses, occasional big wins. Boring, profitable. Which brings us to the rule everyone has heard and almost nobody applies correctly. Risk 1% per trade. Sounds simple. Here's the catch. Not all 1% is equal. A 1% risk trade on Euro US dollar and a 1% risk trade on US dollar Zonarog are completely different animals, because US dollar Zonarog has wider daily ranges. Your stop has to live further out to respect that volatility, which means either fewer lots or your account swings twice as hard for the same nominal risk. The fix is volatility adjusted sizing. Use the 14-period ATR, average true range, to set the stop distance instead of a fixed pip count. Then size the position so the dollar value of the stop equals 1% of your account. On US dollar Zonarog, that produces fewer lots than on Euro USD. On a quiet Euro USD session, more lots. The real risk stays consistent across instruments. That's the part the 1% rule on its own leaves out. And then there's the trap that catches even disciplined traders. Correlation. Long Euro USD and long GB Pound USD looks like 2 trades. It isn't. Both pairs run off the same driver. A weaker dollar lifts them together. 80% plus correlation on any given session. You haven't diversified. You've doubled down. Same trade, twice. 3 buckets to know. USD weak. Euro USD, GB Pound USD, AU dollar USD, NZ dollar USD. All rise when the dollar falls. Safe haven. USD JPY, USD SFANT, gold. All move on risk-off sentiment. Commodity. AUD, NZD, CAD, driven by the commodity cycle. 3 open positions in the same bucket? That's 1 position with 3 times the exposure. Size it that way. Drawdown limits next. Set a hard ceiling at the account level. When you hit it, you stop. Not, I'll take a break tomorrow. Stop. Today. Losing streaks don't just cost money, they break discipline. The trader chasing a drawdown takes setups that don't meet criteria, doubles size to recover, moves stops, abandons the rules that made the system positive to begin with. The hard stop preserves capital and resets the emotional state. That's its real job. Leverage. The broker offering 30 to 1 is not telling you to use 30 to 1. Most retail traders confuse what's available with what's required. Here's the difference. A 5,000 euro account trading 0.1 lots on Euro USD sits at roughly 2 to 1 effective leverage. The broker permits 30 to 1. You're nowhere near it. That's the right side of this. Low effective leverage means smaller positions per unit of account, slower compounding both ways, and a margin call that's essentially impossible under normal conditions. Traders running 20 to 1 routinely are one news event from a wipeout. Traders running 2 to 5 to 1 survive almost any condition the market throws at them. Use the minimum leverage your strategy actually needs, nothing more. And here's the piece that ties everything together, the journal. Risk management is only real if you measure it. Every trade logged, entry, exit, intended stop, actual fill, slippage, the specific setup, your emotional state, and whether you broke a rule. Then weekly review. Was sizing consistent at 1%? Were stops respected? Did you take setups that didn't meet criteria? Was expected value per trade actually positive? Without that loop, risk management is an aspiration. With it, it's a measurable discipline you can improve. So, back to the thing at the start. Most accounts don't blow up because of the strategy. They blow up because the 1% rule was applied without ATR, because 2 positions were really 1 correlated bet, because effective leverage was 4 times what the strategy needed, because there was no hard drawdown line and no journal to catch the drift before it became a habit. 8 rules. Stop at a technical level with a pip for spread. RR that survives a 40% win rate. Size by ATR, not fixed pips. Treat correlated pairs as 1 position. Hard drawdown ceiling. Effective leverage under 5 to 1. Journal every trade. Review weekly. Get those right and your strategy finally has time to actually work. Get them wrong and the best entry signal in the world won't save the account.
8 rules separate survivors from blowups. Full breakdown linked in the description.